Rating agencies focus on is expectations for growth. Help came from an unlikely sector in the second quarter of this year, mining. But can it last? What are the expectations? To discuss, we're joined by Moody's Douglas Rowlings. Thank you for joining us, Douglas. So what was interesting today was how everything is linked, our sovereign rating linked to companies, vice versa. How is mining affected by South Africa's rating, and how does mining affect everything else?
To start off, in terms of how we're looking at the mining sector specifically, you are correct that we saw an improvement in terms of the first half, but that was largely driven by Chinese stimulus, both on the monetary side and on the fiscal side. But we are starting to see that taper off. So the expectation is we should see a moderation in pricing in the second half, not to the levels we saw in January, so we don't expect a steep decline, but we do expect it will be a lower for longer price environment. How we look at the translation in terms of sovereign linkage is in terms of the production concentration. What is important is when we look at the mining universe specifically, is a lot of these miners are fairly well diversified. So they do have exposure to South Africa, but they are very diversified outside of South Africa as well. So they aren't only exposed to South Africa in terms of production.
Okay, so it depends on China and their other big markets. And what does that mean? This moderation in pricing, you mentioned that low for longer. What does it mean? How low, how long will commodity prices stay low? When do you foresee, if ever, another uptick?
It's a great question. And what is important is what you're seeing in China. So China's economy has shifted. You're no longer having an economy which is focused on very high and intensive raw material consumption. It's now focused more on a high value added goods and service offering to the global economy. So the main director of pricing going forward will be supply reduction. We don't, in our view, see the demand moving back to what we saw in the past decade from China. So it's more the supply coming out, and the market still remains heavily oversupplied, so we expect pricing to remain weak. But there will only be improvement once the supply starts reducing, which we are starting to see come through, which will start supporting a more benign pricing environment in the base metal space.
And with the platinum miners, they talk about the fact that you can reuse the platinum. But talk about some of the gold miners that you rate. How are they looking right now?
So gold is in a very different space to what we see in the base metal space. And if you rewind to 2013, it's almost the situation that you saw last year in terms of base metal price environment. So in 2013, you had a steep gold price decline. And what we see now in terms of the base metal miners was what the gold miners did. So we looked at very steep cost reductions, asset sales, and reducing debt. So the gold miners are almost 3 years ahead. And they are also benefiting from a stronger gold price environment driven by the economic and political uncertainty that we're seeing, which is driving inflows, especially in the EFTs in the US as well as in Europe, which is supporting higher price levels in gold. And what we're seeing from a credit perspective is that it's allowed these gold miners to even further reduce debt. So much so that on Friday we took an action on both AngloGold Ashanti and Gold Fields, where we moved the ratings outlook from stable to positive.
Okay, so that's some good news. The one thing that Moody's always talks about in terms of South Africa is there's a suggestion that our labour market is inflexible, and that's one of the structural reforms that needs to take place. How does that relate to mining, where there's even more pressure, renewed calls to earn 12,000 Rand a month in the gold mining sector, and a lot of strike action in the past?
I think what we're seeing in the context of the mining sector isn't South African specific. Specifically, if we look at the gold price environment, that you're seeing inflationary pressure as gold prices have increased. But that's not only just specific to the mining costs as part of the cost, or the labour costs as part of the cost structure. There have been more pressures in terms of reducing costs, and that has led to reduction of labour complement, but not only in South Africa, but across the broader mining universe. And we've had
You're talking about job losses?
Precisely, but it's not been specific to, and this is only in the base metal space, but across the entire globe in terms of obviously trying to reduce costs.
Okay, we're running out of time, so I need to talk about the oil price because you make predictions. I want to know what your prediction is, what it means for South Africa. We are affected by petrol prices, inflation, what it means for Sasol, what it means for Africa as well.
With pleasure. So we have a view that we should see oil, and we take a sensitized view. So we don't necessarily forecast the oil price, but more where the oil price could go down to. So balance 2016, $40, moving to 45 for 2017, and then 50 for 2018. And what that means for Sasol is that you've also got a weaker rand, which has benefited them on the cost side, and we've just seen their results, and they delivered very strongly in terms of cost savings, where the weakened rand relative to, in essence, a dollar top line has benefited them. But what we're seeing in the broader corporate sector in South Africa is where you do have petrol, diesel as a cost input, there have been favorable translation effects in terms of the actual cost structure for these corporates.
All right, we have to leave it there, but thank you for your time, Douglas Rowlings from Moody's. And let's stay with the mining sector.